The market doesn't care about your feelings. It doesn't care about your dreams, your financial goals, or the mortgage payment due next month. The market is the ultimate revealer of truth, a mirror reflecting back not what you want to see, but what is. Most traders fail not because they lack information, but because they lack discipline. They stand in front of this mirror, seeing only what they wish to see. Consider this paradox. The more connected we become to others in the markets, the further we drift from success. When everyone leans to one side of the boat, that's precisely when it capsizes. The crowd has never been right at major turning points, never. Yet we feel safer following them, don't we? That safety is an illusion that will eventually destroy your capital. True trading success comes when you stand alone, when you can withstand the psychological pressure of isolation, when you can look at a chart, see a pattern forming that nobody else acknowledges, and act on it anyway. When you can watch your position move against you while everyone celebrates being on the other side and still hold firm because you know your system is sound. The greatest traders in history weren't great because they followed others, they were great because they developed the mental fortitude to stand apart, to see what others couldn't see or wouldn't see, to act when others froze in fear or complacency. Jesse Livermore understood this better than anyone. His greatest successes came not from tips or following the crowd, but from trusting his own judgment when it contradicted popular opinion. The question isn't whether you have the right information. Everyone has access to the same charts, the same news, the same indicators. The question is whether you have the psychological strength to act independently, to stand alone when your analysis tells you the crowd is wrong. Can you resist the pull of consensus? Can you maintain your conviction when doubt creeps in? Can you execute your plan when every fiber of your being screams to follow the herd? This is the true battleground of trading, not your strategy but your mind, not your tools but your temperament. In October 1907, panic gripped Wall Street. Banks were failing, credit was disappearing, and investors were selling everything they owned in a desperate rush for cash. The Dow Jones had already plummeted nearly 50% from its peak. Most traders were paralyzed with fear or had already been wiped out. But one man was making a fortune. Jesse Livermore sat alone in his office, calmly watching his short positions grow more profitable by the hour. Months earlier, when the market was still buoyant and optimism filled the air, Livermore had begun to sense danger. His system of price action and market behavior was flashing warning signals that nobody else seemed to notice, or perhaps nobody wanted to notice. He had positioned himself against the prevailing sentiment. While financial papers printed reassuring headlines and market veterans spoke confidently of prosperity, Livermore had methodically built short positions. He weathered ridicule. He endured weeks of losses as the market pushed higher against his positions. He questioned himself constantly, re-examining his analysis, but ultimately held firm to his conviction. When the crash finally came, Livermore made $1 million in a single day, equivalent to over $30 million today, not because he had inside information, not because he was luckier than others, but because he had developed the mental discipline to stand apart from consensus thinking. Yet this same story contains a warning. Just 4 years earlier, Livermore had been completely wiped out. His early success had bred overconfidence. He began breaking his own rules, ignoring his system, letting emotions drive his decisions. Pride eroded his discipline. He stopped standing alone and started following tips, seeking validation, wanting to be liked rather than right. The market punished him severely for this mistake. It always does. This cycle of remarkable success followed by catastrophic failure would define Livermore's entire career. When he followed his rules with iron discipline, when he trusted his own analysis and stood apart from the crowd, he accumulated vast fortunes. When he abandoned his principles, when fear or greed overcame his systematic approach, he lost everything. The market hasn't changed since Livermore's day. The technologies are different. The speed is faster. The same patterns of fear and greed, of crowd behavior and price movement, still dominate. The same emotional traps still claim most traders, and the same truth still holds. True success comes when you can develop a sound system, follow it with unwavering discipline, and stand alone against the crowd when your analysis demands it. When you can separate market reality from market narrative, when you can see the reversal forming while others remain blind to it. This is not just Livermore's story, It's the story of every trader who has found lasting success in the markets, and it begins with understanding a fundamental truth about trading psychology that most will never grasp. The fundamental conflict in trading isn't between buyers and sellers. It's between your rational mind and your emotional brain, between what you know you should do and what you feel compelled to do, between the trading system you've developed and the psychological impulses that urge you to abandon it. This conflict exists because we are social creatures thrust into a pursuit that demands isolation. From childhood, we're taught that safety lies in numbers, that consensus validates truth, that being part of the group protects us. These lessons are burned into our primitive brain, the same brain that now sits before charts and order screens, making financial decisions. But the market operates on different principles. The market transfers money from the many to the few. It punishes consensus thinking and rewards contrarian action, when that action is based on sound analysis rather than mere opposition. The market rewards those who can detect shifts before they become obvious, who can act while others hesitate, who can stand firm while others panic. Consider what happens at major market reversals. As a bull market peaks, optimism reaches maximum intensity. The financial press publishes glowing forecasts. Social media fills with success stories. Everyone seems to be making money. The few voices urging caution are dismissed, even mocked. The psychological pressure to remain bullish becomes nearly irresistible. This is precisely when the disciplined trader must stand alone. When your system indicates potential reversal, you must position accordingly, even as everyone around you continues to buy. You must accept being wrong while the market makes one final push higher. You must endure the pain of watching others profit while your position suffers. The same pattern occurs at market bottoms. When fear is at its peak, when selling is indiscriminate, when even quality assets are abandoned, this is when the disciplined trader begins to buy, not because they're brave, but because their system indicates value. They act while most remain paralyzed by fear, unable to press the buy button even when their rational mind recognizes the opportunity. Jesse Livermore mastered this conflict through ruthless self-awareness. He understood that his emotions were his greatest enemy. The market does not beat them, he observed about failed traders. They beat themselves because though they have brains, they cannot sit tight. Sitting tight, maintaining discipline when every impulse screams for action, this is perhaps the hardest skill to develop. The market constantly tempts you to break your rules. It presents patterns that almost match your criteria, but not quite. It creates streaks of losses that make you question your entire approach. It delivers wins when you break your rules, reinforcing bad habits through random reward. Most traders never overcome this conflict. They develop strategies that look sound on paper, then abandon them at the first sign of trouble. They set stop losses, then move them as the price approaches. They establish profit targets, then exit early out of fear. They study historical patterns diligently, then ignore them when emotions run high. The reason is simple. They haven't truly accepted that standing alone is necessary for success. They want the profits without the psychological isolation. They want certainty before acting, forgetting that certainty only comes when an opportunity has already passed. They want the comfort of consensus, forgetting that consensus is usually wrong at crucial turning points. This need for validation explains why so many traders seek constant confirmation. They check multiple news sources, consult several indicators, ask for opinions on social media, all in an attempt to feel less alone in their decisions. But this behavior creates paralysis, not clarity. Each contradictory opinion increases doubt. Each new information source adds complexity without improving results. The disciplined trader takes the opposite approach. They simplify, they identify the few variables that truly matter to their system, then ignore everything else. They accept that no system works all the time, that losses are inevitable, that being temporarily wrong is part of being ultimately right. Consider risk management, perhaps Livermore's greatest lesson. The amateur trader focuses on being right. They take large positions to maximize gains when their analysis is correct. But this approach inevitably leads to disaster. The market can remain irrational longer than you can remain solvent. A single outsized loss can destroy years of careful gains. The professional focuses instead on surviving when wrong. They position size modestly, risking only a small percentage on any trade. They accept small losses quickly, without emotion. They understand that capital preservation is their first priority, because without capital, all strategies become irrelevant. This approach requires accepting an uncomfortable truth. You will be wrong often. Your brilliant analysis will sometimes miss crucial factors. Your perfect setup will sometimes fail for reasons you cannot explain. Markets will act irrationally, defying all historical precedent. Being wrong is not just possible, it's guaranteed. Most traders can't accept this. Their ego demands certainty. Their self-image can't accommodate repeated failure, so they cling to losing positions, hoping for reversal. They average down on bad trades, compounding their risk. They abandon their systems after a string of losses. Just before conditions become favorable again, they let fear of loss override their discipline. Livermore called this the pain of being wrong. He understood that accepting this pain, absorbing it without abandoning discipline, was essential to success. A loss never bothers me after I take it, he said. I forget it overnight. But being wrong, not taking the loss, that does damage to the pocketbook and to the soul. This is where the true battle lies, not in developing complex strategies or discovering hidden indicators, but in maintaining emotional equilibrium when capital is at risk, in trusting your system when results temporarily disappoint, in standing alone when the crowd moves in the opposite direction. The paradox is that to master this conflict, you must first acknowledge that it will never disappear. The tension between emotion and discipline remains even in the most experienced traders. Fear and greed never vanish. They are simply recognized more quickly and managed more effectively. Livermore himself never fully conquered these emotions. His later failures came when he violated his own rules, when he trusted others over his own judgment, when he let pride override his risk parameters. Even after decades of experience, even after accumulating and losing several fortunes, he still struggled with the same psychological traps that snare beginning traders. This should be both sobering and encouraging. Sobering because it reveals that trading mastery is not a destination but a continuous practice. Encouraging because it suggests that perfect emotional control isn't required, only sufficient awareness to maintain discipline when it matters most. The market constantly tests this discipline. It probes for weakness. It tempts you to overtrade during quiet periods and freeze during volatile ones. It rewards bad habits just often enough to reinforce them. It punishes sound decisions just often enough to make you question them. It creates patterns that seem to match historical examples, then behaves in completely different ways. Standing alone against these tests requires more than just technical knowledge. It requires a mindset that embraces uncertainty, that accepts temporary discomfort for long-term gain, that values process over outcome. It requires understanding that trading is not about being right all the time. It's about being right when it counts, with enough capital preserved to capitalize on those moments. This is the lesson most traders never learn. They focus on strategy while ignoring psychology. They seek complex systems while neglecting simple discipline. They chase certainty in a pursuit defined by probability. And ultimately they fail not because they lack information, but because they cannot stand alone when standing alone matters most. So how do you develop the capacity to stand alone? How do you build the psychological strength to act independently when everyone around you moves in the opposite direction? The answer lies not in finding better information, but in creating systems that protect you from yourself. First, you must understand that your trading system and your psychological discipline are inseparable. The best strategy in the world fails in the hands of someone who cannot execute it consistently. Conversely, iron discipline applied to a flawed system still leads to ruin. You need both a sound methodology and the mental strength to follow it without deviation. Begin by developing clear, written rules for every aspect of your trading, not general principles but specific, actionable instructions that leave no room for interpretation when emotions run high. Your rules should cover entry conditions, precisely what pattern, indicator, or price action must appear before you enter a position, not when the market looks bullish, but when price closes above the 50-day moving average with above-average volume after 3 consecutive down days. Position sizing, exactly how much capital you'll risk on each trade, expressed as a percentage of your total account. Livermore eventually settled on never risking more than 10% of his capital on any position, but modern risk management suggests even smaller allocations, typically 1% to 2% per trade. Stop loss placement, the specific price at which you'll exit if proven wrong, determined before entering the trade. This must be non-negotiable. The moment you move a stop-loss as it approaches, you've abandoned discipline and entered the realm of hope. Profit targets, predetermined levels at which you'll take partial or complete profits. These should be based on your system's historical performance, not on what feels right in the moment or what would make a satisfying gain. Scaling parameters, specific conditions under which you'll add to winning positions. Pyramid up, never down. Add to strength, never to weakness. Increase position size only when the market confirms your analysis through price action. Daily, weekly, and monthly limits, maximum losses you'll accept before stopping to reassess. Markets move in streaks. Professionals understand that when they're out of sync with current conditions, the best action is often no action at all. Once these rules are established, the next step is even more crucial. Follow them without exception. This sounds simple but proves extraordinarily difficult in practice. The market constantly presents situations that seem to justify breaking your rules just this once. Resist this temptation at all costs. Each exception weakens your discipline and pushes you closer to the undisciplined majority. To strengthen this discipline, implement a trading journal that records not just your trades but your emotional state during each decision. Review this journal regularly, looking for patterns of weakness. Do you overtrade when bored, hold losses too long when embarrassed, exit winners too early when nervous? Identifying these patterns is the first step to correcting them. Next, develop pre-trade and post-trade routines that create emotional distance between you and your decisions. Before each trade, review your rules and confirm that all conditions are met. After each trade, regardless of outcome, review your execution against those same rules. This process prevents both the overconfidence that follows winners and the despair that follows losers. Deliberately limit your information intake. More information rarely leads to better decisions. It usually creates confusion and amplifies emotional responses. Identify the few data sources truly relevant to your system, then eliminate everything else. No financial television, no trading forums, no market commentary that might shake your conviction when properly established. Practice scenario planning to prepare for inevitable periods of doubt. Ask yourself, if this position moves against me by 5%, how will I feel? Will I still follow my stop loss? If everyone seems bullish while my system signals caution, what specific steps will I take to maintain my contrarian position? Mentally rehearsing these scenarios builds resilience when they study market history extensively, not to predict the future, but to understand that what seems unprecedented in the moment has usually happened before. This historical perspective provides confidence when standing alone. You're not just acting on personal insight, you're acting on patterns that have repeated throughout market history. Livermore himself summarized this approach. The game does not change, and neither does human nature. The same patterns of fear and greed, of excessive optimism and unwarranted pessimism appear in every market cycle. Recognizing these patterns allows you to act contrarian when appropriate, not out of stubborn opposition but from historical understanding. Develop mechanisms for accountability that don't depend on market outcomes. Judge yourself not on profits and losses, which contain a significant element of randomness in the short term, but on adherence to your system. A losing trade executed properly should be considered a success. A winning trade that violated your rules should be considered a failure, regardless of profit. Finally, accept that standing alone requires periods of being wrong, sometimes very wrong, before being proven right. This is perhaps the hardest pill to swallow. Your timing will rarely be perfect. Your contrarian positions will often move against you before moving in your favor. During these periods, only your discipline protects you from abandoning sound analysis prematurely. Remember Livermore's experience in 1907. Before his million-dollar day, he endured weeks of losses as the market moved against his short positions. Had he abandoned his discipline during that difficult period, he would have missed one of the greatest trades of his career. The same will be true for you. Your biggest successes will often come after periods of greatest doubt. This framework, clear rules, unwavering discipline, limited information, historical perspective, and acceptance of temporary discomfort, forms the foundation for standing alone successfully. Not just surviving as a contrarian, but thriving when your analysis diverges from consensus. Not just having the courage to act independently, but developing the systematic approach that makes such actions sustainable. The path of the trader is fundamental. This truth cannot be escaped, only embraced. In a world that celebrates connection, that values consensus, that rewards conformity, trading demands the opposite. It requires the courage to disconnect when necessary, to reject consensus when your analysis contradicts it, to stand apart from the very human impulse to seek safety in numbers. This is not a path for everyone. Most will never develop the psychological strength required to truly stand alone. They'll continue seeking validation before acting, comfort before truth, confirmation before conviction. They'll follow the crowd right over the cliff edge, then wonder why their results never improve despite accumulating ever more knowledge. But for those who recognize that the real battleground is within, that mastering your psychology matters more than mastering technical indicators, a different possibility emerges. You begin to see market movements not just as opportunities for profit, but as tests of your discipline. Each trade becomes not just a financial decision, but a moment of self-revelation. What you do when your position moves against you reveals more about your trading future than any winning streak ever could. Jesse Livermore understood this. The game of speculation is the most uniformly fascinating game in the world, he said. But it is not a game for the stupid, the mentally lazy, the person of inferior emotional balance, or the get-rich-quick adventurer. They will die poor. The market never stops teaching this lesson. It never stops testing your resolve, probing your discipline, challenging your conviction. It never becomes easier to stand alone. You simply become stronger through the practice of doing so consistently. Ask yourself honestly, when was the last time you maintained your trading discipline while everyone around you moved in the opposite direction? When did you last take a loss promptly without hesitation because your rules demanded it? When did you watch a position move against you without moving your stop loss? These moments, not your profits, define your identity as a trader. The ultimate paradox of trading is that true independence leads to the most reliable results. These moments, not your profits, define your identity as a trader. The ultimate paradox of trading, not independence from knowledge or method or discipline, but independence from the psychological pull of the crowd, independence from the need for constant validation, independence from the fear of being temporarily wrong. This is how you succeed in trading when you stand alone, not by having better information than others, but by having better discipline than yourself.